Hi everyone, welcome back to the US CPA classes for regulation exam. In this particular video of US individual taxation, we are going to start with adjustment and deduction to arrive at adjusted gross income. Like at the primary level, difference between how we do like treatment of standard deductions and Section 80 deduction here in India compared to standard deduction and itemized deduction in United States of America. So, like itemized deduction are more or less similar to how we have Section 80 here in India, right? When you make an payment for, like Provident Fund, LIC, PPF, mutual funds, or maybe interest on home loans, right? So you get certain deductions for that, right? Under Section 80, there are different subsection, right? For medical insurance, it's 80D, for LIC and everything, like ATC, and for educational. So there are different subsection to it, but high level, like all the deductions of Section 80 which you are receiving is more or less considered similar kind of deduction and slightly different in itemized deduction. But in India, the situation is you get the benefit of both. You can reduce standard deduction, and then after you can reduce Section 80D deduction, Section 80 deduction, right? Whereas in US, either you can choose standard deduction or itemized deduction. You cannot take the benefit of both, right? So as a tax planner, as a tax advisor, we need to evaluate which one is more beneficial to taxpayer, and accordingly we need to suggest him or her, right? So in US, the key difference is either you can choose standard deduction or itemized deduction, whichever is more beneficial to the taxpayer. But one more small thing which you need to keep in mind, if you remember, like when we started doing US taxation study, so initially we study about residential status, right? Hope you remember those.
Yes, sir.
Right? There are three type of residential status: citizen, resident alien, and non-resident. Right? So in the resident alien, we studied all the three conditions. Right? One is like married from some US citizen, second is green card holder, and third was physical status. Right? To consider any individual to be a resident alien of United States of America. And the person who is neither a citizen nor a resident alien is considered to be as non-resident alien of United States of America, right? So for non-resident alien, like when you're filing the tax return, there are many people who may be citizen, who may be non-resident alien, but there may be possibility you get some tax returns to be filed for non-resident alien as well, right? For the non-resident alien, they are not allowed to have standard deduction. Standard deduction is only allowed to either to citizen or resident alien. Standard deduction is not allowed to non-resident alien. That is something you need to keep in mind. And another important thing you need to keep in mind, for resident alien and for citizen, either the standard deduction or the itemized deduction, whichever is more tax beneficial, that proposition you will be using, right?
Sir,
But you cannot use both.
sir, can you add this point that standard deductions are not allowed for non-resident?
I think I have written somewhere. So I'm just, as of now, I'm just giving you overview. We'll
Okay.
go to this theory one by one. So I think I have written somewhere, but if not, I'll definitely add into it. Right. So this is like high level overview, or you can say understanding about standard deduction or itemized deduction. Standard deduction, as the name suggests, like for, if you remember, there are five type of filing status we have in US. What are those five types?
Single.
Yep.
Second, married, filing
Mm,
separate.
mm,
Third one, married, filing
Filing joint.
jointly.
mm.
Then, head of
Household.
houses and
Mm.
qualified widow.
Qualified widower, right? So for each tax filer, there are different amount which can be considered as standard deduction. So that also will be studying, and like you don't need to mug up, but high level you should have an understanding. For exam purpose, absolute number, I don't think so anyone will be asking you, but you should have fair idea, like about these numbers. And then like there is some additional or you can say top up
standard deduction for people who are senior citizen, like more than 65 year of age, or maybe like disabled or blind kind of people, right? So that also we'll be discussing in standard deduction. And then in itemized deduction, there are 6-7 categories, same way like how we have in India for section 80C, D, E, so on and so forth. Same way, there are 6-7 topics we'll be studying in the itemized deduction. And within those itemized deduction, for each category of itemized deduction, there are sub limits kind of it, right? Up to what amount can we consider as for the itemized deduction. So that we'll be studying, right? So this is like high level, you can say overview and understanding of what is standard deduction and what is itemized deduction. So let's dive into for more detail. So here,
And
yes, please.
so does this change, this number change year by
Yes,
year?
yes, yes, yes. So, like every year, you can go to the, I think you all are being familiar with IRS website,
Yes, yes.
right? So IRS website, every year you can take a look at change in standard deduction. So, so there are publications which you can take a look. I'll send you the link in group, so where you can see all these deductions changing year over year. So it's being available on IRS. So like every time we also update our book from IRS website, to be very honest, just to be on sync with what is latest on the IRS website. So maybe after the class, I'll send you the link where exactly you can go through
Okay.
to see like every year change in the limits. Hmm. So now coming to the theory part, adjustment and deduction to arrive at taxable income. So if you remember from the computation of income, so there's the gross income, then exclusion, then after you reach at the income, then exclusion, then you reach at gross income. From gross income, there was certain adjustment to reach at adjusted gross income. From the adjusted gross income, you'll be reducing these deductions, either standard deduction or itemized deduction. It will give you the taxable income. So income at which tax rates need to be applied, right? So in India, we call it slab rate for individual, if you remember, right? In US, we call it marginal tax rates. So after this topic, we'll be going to the marginal tax rates also. And we'll see if time permit, we'll cover that topic also today. Right. So coming to the adjustment and deduction. So there are two types, standard deduction and itemized deduction, like we were discussing. Standard deduction we'll be covering in note 1, but quickly let's understand itemized deduction. So out of this, whichever is more beneficial to the taxpayer, you should be considering. So in case of married filing jointly, both the spouse need to opt any one option. It is not permissible that one spouse choose standard deduction or other spouse choose itemized deduction. Yeah, this is also very important. Hmm. So first thing is you can choose either itemized deduction or standard deduction, right? But you can, if you are filing a joint return, right? So it is not possible that one spouse choose itemized deduction and one spouse choose standard deduction. They both have to reach to a consensus that together they will be choosing either itemized deduction or standard deduction, right? Because it is going to be a single return. It is not going to be two separate return. Clear? So far, so good? Yes,
Yes,
no,
sir. Yes, sir.
thumbs up, something. Okay, so then the note over here is additional standard deduction for the age 65 or greater or for blind person. So there is some additional standard deduction. So these are the limits for unmarried, or I would say unmarried oblique single, right? So $13,850 is the standard deduction. If the individual is more than 65-year age, then 1,850 extra. Or if the individual is blind, then also 1,850 extra. Right? Clear? Married filing jointly, if you see, is almost double, 27,700. But here, for individual who is more than 65, the additional deduction is 1500, right? And if one person is blind and one person is more than 65, then additional 1500, right? So maximum additional adjustment will be $3,000 for married filing jointly. Hmm? Then after qualified widower with dependent child. So if you remember, we discussed earlier also, qualified widower with dependent child get almost similar benefit of married filing jointly. So 27,700. So that's a higher limit of standard deduction as he or she is individual, right? So $1,500 will go if more than 65 or blind, right? Head of the household, if you remember, like in the beginning I shared, like head of the household position is somewhere in between single or married filing jointly. It is more advantageous than single but slightly less advantageous than married filing joint return. So if you see, 20,800 is the limit, which is more than $13,850 for single, but less than married filing jointly, which is 27,700, right? 20,800 for head of the household plus 1,850, which is if the head of the household is more than 65 years of age or blind. Married filing separately is 13,850, but if he or she is more than 65, he or she will get 1,500 extra, right? Here the difference between single and married filing separately is if the individual is more than 65 year, then in case of single it is 1850, in case of married filing separately it is 1,500. So that's a small difference there. So far so good. If the person is both blind and above 65 age, he or she is eligible to claim double additional deduction, right? I know when we are discussing these amounts, some of you may have this question in your mind, right? If the person is blind as well as more than 65, he or she can get double benefit of it. Clear?
Yes, sir.
Okay. So note over here is married filing jointly, both spouse need to choose one option, either standard deduction or itemized deduction. Different option for different spouses not permissible. I think this we have already covered above. Right? Married filing separately must have to file their tax return if the gross income is more than $5, right? So the minimum income limit is $5, right? If you have income for more than $5, you have to file the tax return in case of married filing separately, right? Additional standard deduction for dependent is generally limited to greater of the following. So if you have dependent, then you can get additional standard deduction, right? Which is 1,250 in the year 2023, and this also keep on changing year over year based on their inflation index. The individual's earned income for the year plus $400 for 2023, but not more than the regular standard deduction amount 1,350 for single for 2023. So additional standard deduction for dependent, right? Dependent generally would be for head of the household or for a qualified widower, there would be dependent, right? 1,250 for that. The individual earned income of the year plus $400, but not more than the regular standard deduction amount of 13,850 for 2023.
Sir,
Mhm.
sir, as I can see, the numbers is ending with 850, 700. So is it any rational or something like some computation based on that this lesson is giving, or is a random amount?
I think there would be some same way how we have inflation index, CII, if you see in India, when you calculate a capital gain. So there may be some index based on which every year they are changing.
So it's keep changing every year.
Yes, yes, this number keep on changing every year.
But in India, we have a fixed amount of standard deduction every year, no changing.
No, no, every finance budget they make some changes. they increase generally.
Generally it end with a round of number. If he is 850, 700, is like there's some working based on that this reduction is given.
Yeah, I'm sure they might be doing some working before it comes to the finance budget. Because every year in finance budget, these limits are updated.
Okay.
And there, I'm sure there would be some, calculation, math behind it. But I'm expecting it will be like the inflation rate, or maybe like other GDP factor and other factor might be they'll be considering each year.
Sir, can you explain this additional standard deduction for dependent again?
Yeah. So additional standard deduction for dependent is they are saying 1,250 or the individual earned income plus $400, but not more than the standard deduction amount for single, like 13,815. So you get either of, like whichever is, like I would say,
So
greater.
if you assume that an individual has earned
Hmm.
income of 13,850,
Hmm.
so if he is opting for standard deduction,
Hmm.
then at more plus to that he can also choose 1250 because it
Hmm.
is greater than
Yes.
$400,
Hmm.
right?
Hmm. Let me do a small example for the benefit of everyone. So, for example, this is Mr. A, right, is earn income. Let's assume is $20,000, right? And standard deduction for him is 13850, and dependent additional deduction we need to calculate. So this is 1250, option 1, right? Option 2 will be what they're saying, the individual earned income of the
Plus
year
400.
plus 400, right? So earned income is 20,000 plus 400, plus 400, but not more than the regular standard deduction,
Yes.
right? So if it is more than 13850, then this will not be the situation, right? Hence option 1. So additional deduction, dependent additional deduction is following options. But in this case of scenario, it is 0 and 1250 will be there. So whichever is more beneficial to taxpayer. This is what it means. Make sense?
Okay. Okay.
So
And
the individual earned income for the year plus 400, but not more than the regular standard deduction amount this. So total earned income plus 1400. For example, if the total earned income is this much, right? So in this
yes.
case of scenario, the total deduction would have been gone to this much, 1040.
Sir,
Means,
in this case as well,
hmm,
he will not be able. Even if he take to the standard deduction,
hmm,
then also his income will be non-taxable.
yeah.
And we are missing one thing, like there is a clause for number of dependent as well as the criteria of dependent, like age, disabilities, and all those things.
Yeah, so that will be studying along with tax credit topic, where we have explained in detail who is dependent and what all criteria need to be met for consideration of dependent. Because in the tax credit there are various type of dependent, like child tax credit, dependent care credit, disability credit. So there we have explained this.
Okay, sir. Okay.
Right? Standard deduction is not allowed to here. Like I think you are asking this question, so
Yes,
I
sir.
think
Yes,
it's
sir.
explained here. Standard deduction is not allowed to non-resident alien and taxpayer filing for a period less than 12 months. That means, for example, first time your client has started earning, right? So the total tax year is maybe like 6 months, 7 months, 8 months, right? So in that case of scenario also, standard deduction is not allowed because standard deduction is for full year.